Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday everybody. I hope you had a productive week and have a restful weekend ahead. We begin today's video with some positive stories, shining some much needed optimism on the economic outlook. However, later in the video we do still have some deeply concerning developments we need to cover too. After more than a year of malaise, Chinese e-commerce giant Alibaba Group Holdings Limited has returned to growth across all of its main divisions. On Thursday, the Jack Ma-owned company said revenue grew 14% year-on-year in the quarter ending June 30th. Net income rose 50% to 34.3 billion yuan, also beating expectations. The company's US-traded shares rose by 4.5% in pre-market trading the day the results were published. Alibaba's main business, Taobao and Tmall Group, saw revenue rise 12% year-on-year to 114.95 billion yuan in the June quarter. The company's labors in overseas markets are also bearing fruit, with revenue from international commerce retail jumping by 60% year-on-year to 17.4 billion yuan in the quarter. Alibaba's cloud business reported more modest revenue growth of 4%. What are the implications of this surprise success for the wider Chinese economy? Well, it could be argued that the performance of a major e-commerce company can act as a proxy for consumer demand. However, we must be cautious of the fallacy of composition. Just because one sector or one actor within one sector is doing well doesn't mean the entire economy is doing well. Indeed, often an economy can be doing poorly while some actors or sectors within the economy do well, and vice versa. We need to take a more holistic approach when thinking about the health of the economy generally and consumption specifically. In saying that, Alibaba's strong showing is much needed good news for those concerned about Chinese retail spending, and at the very least, markets seem excited about the company. Quote, "We view the solid revenues and profit delivered as what the street has been waiting for. Most investors had expected an okay quarter, but the magnitude of the outperformance, especially on the profit beat, likely has exceeded most expectations." End quote. After surviving turmoil beginning back in 2020, when Beijing launched a regulatory assault against its biggest private companies, especially technology companies, China's largest tech players, Alibaba and Tencent Holdings, this year are beginning to claw back revenue and market capitalization, gaining $70 billion of market value since May's end. Of course, they are still well below the pre-crackdown levels when it comes to market cap. Next up, according to data released by the General Administration of Customs China, which is relatively reliable, as the numbers can be confirmed when looking at imports from other countries, China has retained its momentum as the world's #1 auto exporter during the first half of 2023, exporting 300,000 more cars than Japan. In the first half of this year, Chinese auto exports surged 77.1% to about 2.34 million cars. Analysts explain that the jump has been driven by rising demand for new energy vehicles, of which the heavily subsidized Chinese cars enjoy a strong competitive edge, as well as increased Russian deliveries. According to the Japan Automobile Manufacturers Association, Japan exported 2.02 million vehicles during the same period, a respectable 16.8% year-on-year increase. In a Monday report, Secretary General of the China Passenger Car Association expressed that strong demand in Europe for EVs will sustain this powerful performance into the second half of this year. Some analysts are predicting that Chinese automakers will ship more than 4 million vehicles overseas in 2023, cementing it as the world's top auto exporter and confirming its regicide of Japanese automakers. The China Passenger Car Association this week also projected an even more optimistic 5 million vehicles shipped. We will need to see. This, of course, is all good news for Chinese production and exports. However, we must once again avoid the fallacy of composition. Just because auto exports are surging doesn't mean that all exports are doing well. Indeed, we remember from earlier this week, coming off a high base, exports in July plunged 14.5% in dollar terms. As we can see, while car exports performed well, on balance, this was outweighed by a decline in almost everything else. In addition, some hurdles lay ahead for Chinese EV overseas efforts. The EU is a lucrative market. However, as regular viewers know, protectionist sounds are coming from some political corners on the continent, most critically in France. In May, the French government announced a plan to subsidize buyers of new EVs that are made in Europe. And some European leaders have called for more protections against what they argue is another subsidized Chinese industry designed to destroy European competitors, like steel in the past. Beijing will likely leverage its relations with the Germans, whose automakers are heavily reliant on the Chinese market, to counterbalance the protectionist impulses of the French. Chinese financial media outlet Yicai writes that another big challenge is from the United States, where the Biden administration in August 2022 signed into law the Inflation Reduction Act, which includes a provision entitling car buyers to a tax credit of up to $7,500 for the purchase of an EV assembled in North America, while barring so-called foreign entities of concern, which would likely include Chinese car makers. Okay, that is some of the good news. Next up is Country Garden Evergrande 2.0. Hey everyone, if you enjoyed today's episode of China Update, don't forget to hit that like button. Liking, sharing, subscribing are all huge helps for the channel. It's just me making these every day, but with your guys' support, it's a huge source of motivation. For anyone who can go the extra mile, Patreon and Buy Me a Coffee links are in the description below. This helps keep the channel financially sustainable. This means I can continue producing 6 episodes a week without any paywall. As always, thank you so much everybody for the ongoing support. Finally, for today's video, an increasingly vocal chorus of analysts are warning that giant property maker Country Garden Holdings Co., one of the few private property developers to have so far managed to avoid defaulting on its bonds, could be the next major developer to fall prey to the ongoing property crisis, which is now entering its 3rd year. They warn too that the fall of this country garden domino could be more destabilizing and consequential than the initial Evergrande default. According to Chinese financial media outlet Caixin, the Guangdong-based company failed to make interest payments totaling $45 million on 2 offshore US dollar bonds due on Monday of this week. The developer now has a grace period of 30 days to make the payments, and if it fails to do so within that time, it will be in breach of the terms of the bonds. Let's first look away from the forest and focus on the tree. Who is Country Garden, and how are they looking? The short answers, very important and not good. For the longer answer, Country Garden held the #1 position on the China Real Estate Information Corp list of the top 100 property developers by sales value for a number of years, ahead of Evergrande. However, since the breakout of the housing crisis, which as we have seen has disproportionately hurt private developers, it has fallen to 6th place in the first half of 2023. This is also because this developer, in particular, focused on the lower end of the house building market, looking at building apartments primarily in 3rd and 4th tier cities, which have been hit hardest by the property slump. On yesterday, the company said in a Hong Kong exchange filing that it expects to report a record multi-billion-dollar net loss for the first half of this year. Specifically, it estimates a net loss of 45 billion yuan to 55 billion yuan, 6.2 billion to 7.6 billion US dollars for the first 6 months of 2023, compared with a net profit of 1.91 billion yuan a year ago. For the first 7 months, Country Garden's sales fell 35%. Sales in July dropped 60% year-on-year. the fourth consecutive month of month-on-month declines. In 2022, the company recorded a loss attributable to shareholders of 6.1 billion yuan, the first since it went public in 2007. At the end of 2022, the property giant had 1.7 trillion yuan in total assets and 1.4 trillion yuan in total liabilities, including 271.3 billion yuan of interest-bearing debt. In the filing, Country Garden Express, quote, "Due to the recent deterioration of sales and refinancing environment, the available funds on the books of the company have been continuously reduced, resulting in a phased liquidity pressure," end quote. Okay, now moving back to the proverbial forest, we can see now why Country Garden may not be able to meet its overseas debt obligations, which it failed to pay on Monday of this week. Though still in the grace period, this missed payment has, quote, "sparked fresh concerns that a potential default by Country Garden could be as severe as that of China Evergrande Group," end quote, in the words of one Bloomberg analyst. While Country Garden is not as indebted as Evergrande, it has been viewed by the market as one of the healthiest private developers. Its default would radically affect market views of the already heavily shaken industry. On Thursday, ratings firm Moody's Investors Service downgraded Country Garden 3 levels from B1 to Caa1, signaling a very high credit risk. Are you thinking what I'm thinking, B1? I think I am. Caa1 doesn't quite have the same ring to it. With the downgrade, Moody's expressed in an online statement, quote, "The downgrade reflects Country Garden's heightened liquidity and refinancing risks in view of its deteriorated liquidity and financial flexibility, sizable refinancing needs, and still constrained access to funding," end quote. The market is concerned too. Prices of its onshore and offshore bonds have been falling. One of the offshore bonds maturing in January of next year this week is trading at around 22 US cents on the dollar, down more than 70% from mid-June. We end this part and today's video with this observation made by a senior financial institution source speaking to Chinese financial media outlet Caixin on the condition of anonymity. Quote, "This is all a microcosm of what's happening across the real estate industry. Country Garden has done all a company can do, but things are not looking good," end quote. Okay, that is today's episode of China Update. Have a good Friday, have a lovely and restful weekend, and I will see you all tomorrow.